So these are two cuts which are coming through. Cement had a good day yesterday. They're seeing some pullback at the open. Ultratech is down 1%. Bajaj Finance is another one which is down 0.75%. So just mentioning some stuff with volumes. HDFC, ICICI Bank. So banks broadly are the other space which are seeing some amount of pullback right now. 75 points lower on the Nifty. The top two volume-led gainers are Paytm and Policy Bazaar. So that kind of tells you where we are at. And of course, I mean, if you want to add Nykaa to the list, Nykaa is up about 1.33%. And all three names are up there with lots of volumes. A standalone refiner like MRPL is another one, which is up some 4%, 60.61. Westlife is up 3%. We already mentioned that. I guess we'll just wait for new things coming into the mix. By the way, look at the futures premium, right? I mean, 150 points. Even though the spot is down 68, futures are at about 18,894. That's a 150-point premium on top of spot at this point in time. Reliance doing its job with a 0.6, 0.7% kind of run that we are seeing. It's done well over the last few sessions. Our market master of the day is Harsha Upadhyaya, Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, great to have you with us here. Thank you very much for your time. You know, we had Pankaj with us, some time back, not very far back, who was kind of warning us about the fact that maybe at the margin, some of the corporate profitability matrices are deteriorating. Operating cash flows for one. I think that's the one that he was most worried about. Working capital cycles getting a little longer. Just want to start there. I mean, do you share his concerns, and how does that impact how you're managing your portfolio?
Good morning. Yes, some of these concerns are definitely there. It's not that although we have made new highs in the market, everything is hunky-dory. But I would say that some of these issues would get sorted out over a period of time, as we are seeing commodity cost pressures going down, and also the increase in working capital that we have seen is also to do with how we came out of the COVID period, right? Most of the companies had streamlined their inventory to a large extent. The inventory pipelines were yet to be filled, etc. And that's taking place now. And at the same time, we have also had commodity prices going up, which makes the overall working capital requirements to be high. Given that we have seen increase in working capital needs, which is also showing up in bank credit growth, for example. But as we go ahead over the next few quarters, we believe that inflation is going to moderate, and thereby some of these issues should improve. Profitability metrics for companies also should improve. And as it is, the leverage levels in the overall corporate sector is much lower. So to that extent, I think this is a manageable issue. I don't think that would spook the overall markets at this point of time.
Harsha, morning, and thanks so much for joining in. This is Reema here. Would you dig deeper down into the small cap, mid cap universe? Because that's where there has been some amount of underperformance. So in the sectors that you like, is it time to hunt for value lower down the market capitalization?
Reema, we have been looking more at large caps at this point of time. Clearly, I think the pain that we discussed earlier is much more visible in the mid and small cap segment, not as much in the large cap segment. And also, usually, whenever there is some macro headwind externally, you would see large caps behaving much better. So to that extent, and also the fact that mid and small caps have outperformed large caps by a wide margin in the last couple of years, we believe that the risk reward is favorable in large caps as compared to mid and small caps at this point of time.
Hi, Harsha. Morning. What about the IT space? That surprised everyone. The US yields have cooled off. We've seen a relief rally out there. I think you're all a little bit cautious on that space, right? Do you still maintain that cautious view? Or with the kind of developments we have seen, do you expect things to move on?
Nigel, what we have seen currently is some re-rating in terms of valuations, which is understandable, given that interest rates are negatively correlated with equity valuations. And if there is a belief that at some point of time in the near future, there will be a pivot in terms of interest rates, definitely that's positive for equity valuations. And some of the beaten down stocks and stocks where there is growth you would see some of those stocks getting re-rated in the expectation of interest rate movements. That's what exactly has happened in case of IT sector. However, in terms of the overall business outlook, I don't think something has materially changed as of now. Yes, maybe at the margin things would improve from here on, but we need to wait and see how it happens. For example, if you look at most of the commentary that has come post the results of last quarter, you would notice that most of the companies have been cautious in terms of outlook. The furloughs this quarter is at a higher level as compared to what you would generally see during this quarter in the previous years, etc. So overall, I don't think from a numbers perspective, anything has materially changed for the IT sector. But definitely, it was the most underperforming sector over the last 1 year, and we have seen a bounce back in the market valuations, and along with that, this sector has also bounced back. Yes, tactically, there could be some space for IT stocks to still do well in the immediate short term. But we need to really see how 2023 overall IT budget will pan out and how that's going to impact businesses. That will be more structural rather than what's happening in the market.
Harsha, by the way, PB FinTech is come off. It was up 6%. It's up some 3.5%. It'll come up. It still remains the top volume traded name. Paytm, though, has picked up a little bit. It's up a full 4% now, 520 on Paytm. Harsha, on some of these names, a little bit of the street is getting analysts, etc., getting a little constructive. Maybe because the price has fallen a lot, and at some price. At least a few start to see some value. What's your sense? I mean, anything looking interesting here?
On the overall internet space, we have been by and large very, very selective and very, very cautious even in the past, and that situation continues. Yes, stocks have lost a lot of value, but we really do not know whether that's the bottom for some of these stocks. Because there is going to be a consistent supply that's coming from some of the strategic or financial investors that were there in many of these companies. And at the same time, we probably understand some of the traditional businesses much better, both in terms of business as well as in terms of what valuations they should trade at, as compared to some of these new age companies. So the portfolio tilt is obviously is towards some of those businesses where we understand business dynamics and valuations better. That's been our...
Harsha, we've often seen that financial market performance precedes the earnings performance. We've started to see earnings growth pick up significantly. The outlook is a lot better for the banking space. But is it already priced in? Because as I said, usually stocks price in these things well in advance, well before the turning point. So is there value still left in chasing banks at these levels?
If you look at a larger cycle, yes, there is still some more time before we can call it a peak. But in the very short term, yes, markets have moved up quite sharply over the last couple of months. So to that extent, one needs to be cautious in terms of how markets would behave in the very short term. But I would like to point out a few characteristics that are associated with a late stage bull market, and none of those are present at this point of time. Although we have been making new highs on a regular basis in the last couple of trading sessions, we have seen none of them actually. For example, there is no euphoria around new IPOs. Hardly you hear about IPOs these days. If you look at the proportion of stocks, especially from a broader segment, which are making new highs on a daily basis, that proportion is really, really small at this point of time. If you look at the institutional flows into the market, for example, although you may see about $4.7 billion of inflows from foreign institutional investors last month, most of it is also at the headline number. I mean, if you dig deeper, you will find that foreign direct investments have gone down to almost similar extent because some of these blocks which came from private equity investors have been bought by portfolio investors. So net, we have not seen any large inflows from foreign institutional segment. Similarly, if you look at domestic mutual funds, the SIP flows have been consistent, but overall flows have definitely gone down over the last 3 months. And if you look at the overall earnings outlook as well, there is not so much of an euphoria and upgrade cycle as it. So clearly, these are not typical of a late stage bull market where you don't see euphoria at all. For us, I think, there is some way before you actually call it excessive valuation, or one needs to be really cautious about the market. But having said that, in the very short term, yes, markets can be volatile, especially since it has moved up quite a bit in the recent times.
Harsha, final question before we let you go. I recall we had a chat on city distribution, gas distribution companies. The Kirit Parekh report, the recommendations at least are more pro these companies. What's your take on it? Gas pricing, the input cost is likely to come down substantially, 18 to 20%. We had the IGL management who spoke to us yesterday. What's your take on it? Yeah.
Clearly, we have seen energy prices cooling off in the recent times. In fact, crude oil made a new low very recently, although it has bounced back from those lows. We still believe that overall the kind of hikes that were required in the past may not be required as you go forward, as you see gas prices moderating. And if that thesis comes through, then most of these companies are virtually monopolies in their own respect. And they have very, very strong business models and very high return ratios. And definitely you could look at re-rating of some of these companies if gas prices moderate from here on.
Okay, all right. Thanks a lot, Harsha, for stopping by and telling us, giving us your view on the markets. And I'll take that point away that as of now, no